Hey, everybody. Welcome back to today's Market Explain podcast and video series and media event by FourStar Wealth Advisors. I'm Brian Kasal, your host, and we have a very interesting program we believe for you today. I have a new guest co-host today. Sitting in for Chris Reardon is Jack Walsh. So, Jack Walsh, welcome to the podcast.
Thanks, Brian. Thanks for having me.
We'll call him Trader Jack. Trader Jack. Father of three, sports car enthusiast, but Jack's also an experienced trader in the interest rate futures at Chicago Mercantile Exchange. And for the last 15 years, a senior financial advisor, Jack's also the chief operating officer of the largest practice within FourStar. So, Jack, thank you again and welcome to the show.
My pleasure.
And I'm Brian Kasal, founder and CIO of FourStar, Eagle Scout, National Boy Scout Foundation trustee, philanthropic advisor to CEOs and insiders, chief dad to Quinn and Evan, and husband to the amazing Tripty. So thanks everybody for being with us. If you like what you're hearing, please tell your friends and give us a 5 out of 5 on the ranking on Apple iTunes. So we're going to cover the markets today, the economy, and some interesting things that we see out there. Normally, Chris does the market positioning, but Jack, why don't you give that to us today? Where do we stand in the major asset classes, and what's changed since the last time that we met?
Yeah, sure, Brian. Number one is international equities. That's at 246. That's down 3 points. Number two is cash at 207, unchanged. Moving up to number three is commodities, 188. That's up 13. Falling a spot, domestic equities at 184, down 13. Fifth is fixed income, steady at 137. And then last is currencies at 128, which is +4.
Great. Well, thanks, Jack. So underlying, looking at those numbers, we had exactly the same number of tally scores gained by commodities as lost by domestic equities. We'll examine that. And then two of them were unchanged. We don't see that often. There's usually some kind of movement, relative strength between the others. But the domestic equities, the banking stocks, were weakened by the Silicon Valley Bank discussion, which we're going to talk about. And then precious metals rose. Now, those who have been watching in the last year we had a very big commodity rally. And that was one of the reasons for one of our great performing portfolios is we had positions in commodities, oil, and grains. But precious metals didn't move last year, but now they're moving this year. And that has to do with confidence. It has to do with the banking system. Jack, you've noticed also very high volatility in the bond prices, right?
Yeah, Brian, we saw the worst year ever in fixed income last year, down 12%, right? And what changed with the banking crisis, remember we had the Fed out there convincing the market that the terminal rate, where would Fed funds eventually get to? And some people were thinking 6%, right? But as soon as the banking crisis hit, you had 2-year notes up at 5%, right? And they fell towards 360. So that perception about what the Fed would be able to do to squash inflation changed, right? And it changed drastically to the point now where people doubt that they could even go one more time. If you look at the Fed funds futures, and actually predicting by the end of the year, you could see rates on the short end fall back to 4% from 5% now. So you had a big change in interest rate perceptions, which starts to weaken the currency, and it starts to lift commodities, and especially precious metals, because that is insurance. Precious metals are seen as, systemic insurance. So,
well, it's interesting, Jack. I have up on the screen a chart that I've had once before on today's Market Explained program. It's a chart showing the 2022 returns between the stock market and the bond market. So each dot, if you're looking at those who can see on the screen, it'll be on one of the video series. You can see that there are most of the dots are in the upper right fourth quadrant, which means the stock market was up and the bond market's up, and that's the normal state of action. There's a few dots in the box that says the stock market's down, but the bond market's up. There's a few dots in the box that says the bond market's up, but the stock market's down. But there's never been a dot in the box that said stock market down and bond market down. So it was the worst investing year of my 39 years in this career, because so many more people got hurt because the bond market encompasses a significant more amount of more assets than the stock market. Stock market being down is never fun, but a bond market being down 12% like it was last year, Jack, is catastrophic. And as you said, the volatility is really still going on, isn't it?
Yeah. Well, we always call the bonds the safe bucket, right? And, everything is priced off of U.S. 10-year notes, right? And when that becomes volatile and that becomes very risky, even to the point from a volatility standpoint that's higher than stock market volatility, that becomes a big problem, right? And we're still seeing big gyrations in treasuries. And so people really don't know what to think, right? I mean, we still have last print, we had 5 or 6% inflation. And then we have this growing, banking crisis. We said back in 2021 that with the amount of debt, the amount of negative debt in Europe, that if the Fed ever had to go on a course of action, that something might break. And it looks like this Silicon Valley Bank is the first move towards, something breaking.
Right. Well, and a lot of that had to do, Jack, also with the big dramatic change in money movements. Before we had the big banking crisis, we also had, 175 billion move into money markets, right, Jack?
Yeah, 1 week. Yes. And Brian, we even saw that from our customer base. Right, money markets got up to the 4.5, 4.75, and we were starting to bring in money. So yes.
Yeah. So and then $1 trillion left small banks to go to large banks for security reasons. Then as the banking crisis hit, plus the bank deposit funds were not paying very much, so you're getting 1%, but institutional money markets are paying 4.5, some close to 5. So then people were saying the best thing I can do right now is put my money in a big money market.
Yeah.
So it was changing the nature of banking at the same time.
Yeah, that's a big part of the crisis. Big banks, if you had your money at let's say J.P. Morgan or whatever, depositors are complaining. Where's my interest, right? Well, the fact of the matter is a big place like that, they don't need your deposit, right? They could just go into the market and fund themselves. It's those smaller regional banks that really need the deposits, and they saw those deposits leave, and it really caused a lot of stress on their business model.
Yeah.
And then on top of it, go ahead, Brian.
Well, people are learning, Shaq, more about the banking industry, and that fractional banking is what we do. And so if you think about banking, Jack, we're in a position where people are understanding that you put $100,000 in the bank, and then they lend out $1 million. They lend out 10 times more than you put in there, and then they only reserve about 5%. So they only need a small amount of money for people that need money now or whatever, but most people don't pull their money out of the bank. So it's a fractional reserve system, and it's always worked, but it works with heavy regulation to make sure that banks aren't doing foolish things with the money, that they don't lose a lot of money, that they make money on that leverage. So it works, but people don't think about it when we're not going through a banking crisis. But in this case, the regulations failed, and then the supervision of the bank from the San Francisco Fed failed. So Silicon Valley Bank, Jack, was very unique. All the models really didn't work. And so it's not really, we don't see this as a system failure, although there is some stress on the system that it helped cause this decline. But they made specific mistakes in regulation. They ended up having to sell bonds that came out of, you mentioned the hold to maturity segment of the balance sheet that they normally wouldn't have to mark to the market, but then they had to sell some. Once they did, they realized the loss in their capital declined. So they thought we'll just go raise some money from, that's a Silicon Valley thing. They'll just go raise some money. Well, they didn't have enough time to raise money. So, normalcy finally set in that following Monday when Silicon Valley Bank was acquired by another bank and the Fed guaranteed any of the previous losses. So not to the bondholders and the stockholders, but to the depositors. So at least everybody was made whole. Then there's always questions whether they should have done that, because there has to be some risk in the system. But it was certainly also a group of folks that were very favored by the current administration. So now there's calls that maybe they were taking care of their friends by guaranteeing the deposits and all those kinds of things. So, Jack, it's really an issue of confidence in the system, isn't it?
Yeah. And I know from my days down on the floor, Brian, that once we see one firm have an issue, it's always who's next, right? And we saw that over the last 2 weeks, right? We saw really any institution, part of this Silicon Valley story was that they were investing in treasuries and mortgage-backed securities, safe instruments. But the fact that the Fed raised rates so quickly, it did not look like they had any type of dynamic hedging against that risk. So then anybody who had a large percentage of their portfolio and those assets that fell started to get hit. We saw, institutions that were strong before fall in a magnitude 15, 20% one day, right? And then that just carries on. Then people start to look to Europe, and we had the Credit Suisse issue, right? Now, an awful lot of money was put into that. A lot of things were done on a weekend to cobble that deal together. In the previous crisis, they came out with COCO bonds, convertible contingent bonds, right? And then when the equity falls in the stock, those bonds then become equity, creates more pressure on stock prices. The market now is starting to look at big names like Deutsche Bank, right? So like you said earlier, Brian, it is all about confidence and banking confidence. And we see day to day that it really has not formed yet. That we get a couple days, after stocks falling, 20, 30, 40%, they'll bounce for a couple days. But I would say that the market is still not confident that we've got this so-called banking crisis under control.
It seems to be decelerating, but it's not completely controlled. You're right.
That's what it seems like.
Yes. So, what ended up happening is after Silicon Valley Bank kind of kicked it off, then we started having a bank crisis around the country. Smaller banks were losing assets. Certain smaller banks did essentially need assistance from the government. So they arranged for a couple of mergers. So we got into kind of a classic banking crisis. So anybody who's ever seen the movie It's a Wonderful Life remembers when George Bailey, played by Jimmy Stewart, was there and the bank was failing and they were losing their entire net worth. And many people have family stories of members of their grandfathers, great-grandfathers, grandparents going through that situation in the 1920s when many of the banks failed. But the thing that was going on in the movie, back to the movie, is that there were lines outside the bank. Banking crisis took not hours, but weeks to develop, as people had to line up to the bank, demand their money, and they were entitled to their money, and then the bank didn't have any money. So that was the whole drama in the movie. Jack, how much came out of that bank in one day, Silicon Valley?
Yeah, I read 42 billion one day, and that was it. They had to come in and rescue it the next day. So yeah, you're right. I mean, this idea of hopping on your phone and transferring funds, we see it all the time.
Yeah. So this banking crisis was very different. And the technology, once again, made it efficient so people could easily move money from one bank to another in seconds. And that's what happened. So it's even more important that confidence be in the banking system because of the mobility of the bank customers where they can move their money. So banking does work, fractional reserve does work as a system, but there has to be confidence that there's not going to be bank runs and you're going to lose the remaining assets in there. So anyway, it's a really, really difficult lesson for everybody to go through. It's not quite over. We're of the belief that hopefully it will be over and it is not a systemic issue. But depending on how the Federal Reserve and the Treasury Department handles things, it could get worse. We're hoping and we're believing that it probably won't. So let's pray for that. Right, Jack?
Yeah, and Brian, we've said this all the time with our process. We don't make bold predictions, but we know what we'll do when we see it, right?
So as far as the stock market, that's exactly right. So we watch things closely, and if there's stress in the system, we'll be defensive. We'll talk a little bit more about that later on. But you're right. Our process is designed to minimize the damage on the downside to all assets, whether it be bonds or stocks or commodities or anything. So anyway, that we'll come back to that, Jack. So the Fed has been working now for over a year to raise rates to ward off inflation, this terrible inflation. That if it was easy and clear and understandable, the Fed could act without a whole lot of controversy. But the Fed has been blocked all year by some numbers that the federal government was sending out that were confusing and different than the other household surveys. So now many people believe, many economists believe, that there were numbers that were incorrect for over a year. And then some of the numbers came out right before the election that were more positive than the other survey numbers. So now some folks think that they were doing that for the election to make it appear it was not as bad as it was. And we never had to worry about that before. We've always felt that our numbers coming out of the Federal Reserve and the Labor Department were honest and straight. So now there's some question and concern about that because then Biden gave a speech right after a really good number. So it seemed like almost a setup. So we'll see. The key is confidence in the system. And now that we're going through this banking crisis, we had the same issue back in 2008. The Federal Reserve had to guarantee deposits for a period of time. So we might need a federal guarantee again for a while. And if folks think back to the 1979 to 1981 era, back when interest rates were spiking also, the Volcker Fed was getting very, very aggressive in raising rates, but we had banks failing back then. We had all kinds of things exploding, just like we're having now. We had two major world Western countries, Japan and the UK, had a currency crisis at some point in the last 6 months. We also had, as you said, Credit Suisse blew up last fall, and then it finally got taken over. The final blow up was this past week. So there's been a lot of damage to the financial system, but it really was the same thing we saw in the 1979 to 1981 period. The Volcker Fed had to slow down, and now, of course, the Powell Fed has to slow down now as well. So it's a real stressful time, Jack.
Yeah, Brian. I would just say from an interest rate standpoint, right? For years and years, we've talked about the Fed put, right? And basically, the Fed put is, that when things start to break, the Fed will step in to support asset prices. Now, I don't think there's ever been a more difficult spot here that we have 5 or 6% inflation. The Fed would like to continue to raise rates. They don't want to break the system, right? And you actually have people saying, whose fault was it? Was it regulation? Was it this? Was it that? We kept the rates too low for too long, right? And it was able to build up these excesses, right? What I'm telling you now is, once again, the markets that I used to work in are now predicting that they're very close to stopping, highly likely that they'll stop. And by year end, we could see short-term rates go from 5% to 4%, right? And I think the nail in the coffin would be if we had one of those sell-offs that you and I have seen over our 30 years, where it really shakes the confidence of the daily investor, and you get that flush down, and then that big snapback.
Exactly. Well, that's a good segue, Jack. Speaking of the markets, we talk in terms of, okay, banking crises and everything else, but what does that do to the financial markets that we operate in for our clients every day and our investors and individual investors? So we have to say we want to protect the assets on the downside, and we have a process to get there. So we have to ask ourselves, has the market already bottomed, or are we getting ready for another big leg down, Jack, like you were suggesting, that if things get worse and the market goes lower, then obviously we're going to have a worse asset destruction in the market and go down another 15 to 20% from here, perhaps. So have we bottomed? The S&P bottomed at 3794 last October. We're about 300 or 400 points above that now. The Dow bottomed at 31,429, and we're about 1,000 points above that now as well. So we haven't broken the lows of October. But if the numbers come out and they're weaker and the banking crisis gets worse, that will affect the ability to lend. It will affect a lot of things. And so we will probably see those things go lower. But then the question always is, when we get bad news, how does the market react to it? Sometimes the market's already reacted to it, and the cat, the cat's out of the bag, or the horse is out of the barn, if you will. And then instead of going down at bad news, the market goes up, and that's a way you can see in somewhat of a signal that maybe things are over, Jack. Don't you think?
Yeah, I do, Brian. The old trading adage is never fight the Fed, right? And as I said earlier, the market wants the Fed to pivot, right? Now, I don't know if things have to get worse. I mean, I think one of the underpinnings of the market for the year is that people have seen this slowdown coming. This is the most talked about recession ever, possibly. We've had market indicators tell us that from past history, recession is coming. The market will be very happy when the Fed pivots, when inflation starts to fall, or the Fed says we're not going to go to 2%, 3% is going to be fine for now. I think you're absolutely right. We could have a very big market rally for sure.
Exactly. So we have what we call the FourStar Protection Plan, and that's a series of signals that we get that will give us the signal to go to more cash, to get more conservative. We've been holding that money in that high yielding, expensive money fund, which is great.
Right.
People have been getting a 4.7 yield. But we last year, because of the volatility of the market, we had to go to maximum cash, which is the fourth final signal, Jack. If you remember, we had to do it twice. That's the first time I ever had to go to maximum cash twice. And in my 29 years of running portfolios in this fashion, we've only gone to maximum cash 7 times, and we had to do it twice last year. We are not at maximum cash levels right now because we've had a rally off the bottom. But if we see more deterioration, we could be at maximum cash again. Certainly, if we broke the previous lows, those signals would most likely turn. So, we are prepared to take the action we need to protect portfolios, but it certainly won't be a fun time. We'll be avoiding loss. We won't be making a lot of money, but we'll be avoiding loss. But there is a silver lining, Jack. So even if we have a bad market, the good news is that there is no such thing as a perpetual bear market. All markets bottom and eventually go back up. And the other good news is that 80% of the time when the stock markets in America have had a very bad double-digit down year, like last year, 80% of the time the next year is up. So while we're getting close to going negative now in the market, we may go lower and be negative for the year. By the end of the year, there's a really good chance that we'll have rallied in anticipation of a recovery, and then the market will be hopefully up for the year. So the odds are with us, Jack.
Yeah, I would like to mention one of the things that I've said when I first got here is that you never invest for the end of the world because it only happens once, right, Brian? And we used to say that all the time. because we saw so many things bad, happen through the 80s and 90s, and clients would get me on the phone, Jack, don't ever invest for the end of the world because it only happens once.
Right. Well, and then of course the definition of crisis is the same in Chinese. That means opportunity. So when there is a crisis, there is an opportunity. So everyone says, I'd like to buy things cheap and sell them expensive and make money. Well, when they're cheap, a lot of people panic and they're not willing to be there. So we find that we will have some cash at the bottom that we can go back in and take advantage of things. So if we did bottom in October and we get some better signals, the trends, higher highs and higher lows off this bottom, then we will put that money to work, whether that happens now or it happens from a lower level after we break the lows later this year, if that happens. So either way, the idea is that we're looking for the market to show some strength. The market will rally, then come back and not break the previous low, and then go to a higher high than the previous move. So we call it higher highs and higher lows will get us the signals that we need to get all our money back in. And we don't do it right away. We'll do it in increments. We'll do maybe 25% of the remaining cash, and then another 25%, we get another signal. So as we get those signals, we do it incrementally. It's not like a light switch. It's like a dimmer switch. We ramp it up and ramp it down. So we ramped it down, not all the way, but we're ready to ramp it up when it's time, when we get those positive signals. And you have to have a process to do that, or else you'll fall for anything. You won't have a program. You won't know what to do. Everyone's in a panic. But that's the panic of emotions of human beings is what creates bear markets. People are in a panic. They sell. They tend to sell near the bottom, don't they, Jack?
Yeah. Well, and we've seen, Brian, where people that decide, I've had enough, I'm going to get out, right? And they go all the way to cash and they don't have a process. Those people are frozen, right?
Yeah.
They're just paralyzed. I haven't seen a study on it, but you and I know just from seeing those types of investors, they are paralyzed for years.
No, we've seen it in our world here at FourStar and before FourStar, where those who sell near the bottom are paralyzed because then they don't want to buy if it's lower. They think it's going lower. If it goes higher, then they feel like they missed it. So as you say, they're paralyzed. And so anybody who sells in a panic move near the bottom without any plan or any program to get back in will be in cash for many, many years. So you also mentioned, Jack, that we have to be concerned about the economy, pre-banking crisis and post-banking crisis. Let's talk about that.
Yeah. We've started to see, well, let's put it this way. The data in the first quarter was not that bad, right? We don't know if it's not bad because of seasonal adjustments. One of the things that was going on in the first quarter is you still had relatively easy financial conditions, right? You could still get a loan, right? The data that we're starting to see post-banking crisis, they're saying that credit card activity fell off a cliff, right? Mm-hmm. And what's difficult for the Fed right now is not only have they raised rates, but now these financial institutions, credit standards are going to get very, very tight, right? So even though the Fed, may pause here, it's still not going to be easy to get credit. So whereas before you had rising rates, but you had relatively easy financial conditions, you're going to get a tightening of financial conditions, which can make the slowdown more drastic, right? So I would say that the numbers that we saw before the banking crisis, fine, right? Now what's going to happen over the next 2 months? So
we'll see.
Yeah,
we wait. So another conflicting issue is while there are many negative things happening in the economy, we're also seeing other cross currents. Like Jack, most folks recognize it's very hard to travel right now. Everything's very expensive. The hotels are full. My wife booked an overbooked flight the other day. We haven't seen that in a long time. So there's a travel boom on that has now exceeded the record levels of 2019, which was the biggest travel boom in American history. It was in 2019. So that's happening. And also there's a restaurant boom. Even though consumer spending in aggregate is slower, there's a restaurant boom going on right now. It's a rival any restaurant boom we've ever had. So while we're having all layoffs and all these other negative things in the banking crisis, we're also seeing a boom in some other areas. So that's a signal that maybe the recession won't be as bad as everyone fears, that we're going to have a recession. We're probably already in it, but we'll hope because of those factors that it's not as bad, and then the markets may have already bottomed, or if they haven't, they'll bottom very, very soon, and then we'll be hopefully over with this as the market and the economy anticipates recovery. That's what we need. There's a sense of renewal, and the animal spirits, Jack, the way America operates. Then people get hired, businesses grow, and that's the normal state of play in an economy, a capitalistic, free economy like America.
Yeah, I agree, Brian. Yeah, let's just hope that, like I say, I think the market would like to see banking stabilize, right? It is odd that we're likely gonna see some jobs numbers where we actually lose jobs. That's going to be a good sign for interest rates. But yeah, nobody likes to see. And you're right, restaurants, flights, travel. So I am always hopeful, for sure.
So Jack, and we switch to other things we see out there besides the economy. We're seeing the federal government has been playing around with our strategic petroleum reserve. You know a little bit about that?
Yeah, I mean, I saw a chart, and it hasn't been this low since the 1980s, right? And what's concerning is that the reason for the sale, sure, inflation, high food prices. Nobody wants to pay more for their food, and energy is a big cost in transporting food and everything like that. But I would say with other geopolitical situations, I think we should be filling it up and not at all-time lows. But Bri, I think that from the beginning, the energy transition was done in a not so well thought out fashion.
Okay. Well, hopefully they figure that out. We need to maintain our energy stores. We need to maintain our strength. We have plenty of enemies on the world stage, China and others in countries that don't like us. Either they're jealous of us or they just don't like us. Either way, we have to be the leaders in world commerce and maintain that leadership. So anyway, we'll see what they do with the Strategic Petroleum Reserve. A couple other quick things, Jack, before we end it today. There seems to be a new recognition of the invasion of tipping in our society. And I want to mention a little bit about that. Everywhere you go, you're asked for a tip. It used to be you'd go to the restaurant, Jack, and you tip your waitress, and it would be 15% is kind of standard, 20% if they did a good job, less if they didn't, kind of thing, right? A standard program. But that was for people who weren't making a lot of money, and they really survived on tips. So some folks who are good and hustlers could make all kinds of money in the tipping world. But now you go to a retail store, and then you have it on your app, and they have a place to tip your staff and tip. So everybody's asking for a tip, and then everyone can see your tip. So it's one of these things where if somebody will give you a tip, you'll take it. But now they're setting it up with technology to get tips from everybody. So there's this tipping explosion, and everyone's like, wow, wait a minute. This is a little out of control here. There are tip jobs and not non-tip jobs. And if you're getting a good salary or a good hourly wage, you don't really need a tip, do you? You're not working for tips. So there's a backlash now of people who are not tipping the way they used to. And the person behind the counter at the coffee shop is getting paid an hourly wage or a salary. So they are probably not going to get a tip, yet the waitress would get a tip because that's a tipping job. So there's some recognition now that tipping is kind of coercive, and we need to go back to the way things were, where we tip the people who are in tipping jobs. And just because somebody asks for a tip, because you're standing there and you have money, doesn't mean you can give them a tip. So it's kind of one of these cultural things that have changed, and I think there's a number of articles about how there's a backlash about tipping. So, but I've always lived by the credo that if you do have good service, tip big. That way you make sure you get good service when you come back, right?
Sure. I agree.
So and there's a lot of cash out there, Jack. So a lot of people have a lot of cash to tip. And then one other thing, just a totally different subject I wanted to mention. There are certain people who have been on this earth who contributed in a major way to the success of America. And while he wasn't a president or a senator, Gordon Moore was the co-founder of Intel. And he's famous for what's known as Moore's Law, and the Moore's Law said the speed and number of transistors doubles every 2 years in the technology industry. And so we've seen anyone who remembers the early 80s with the 8086 IBM computer, and then the 286, 386, and they kept raising the speed and raising the storage. And now we have gigabytes and terabytes and all kinds of different things that we didn't have in the 80s and the 90s. So technology has really been the efficiency that in many ways has driven the American economy and kept the efficiency going for America that other countries didn't have. Now, of course, the rest of the world is gaining steam in that area. China and other competitors are now more and more in technology all the time. But, Gordon Moore was one of the leaders in that, kind of carving out the concept that technology speed doubles basically every 2 years. So he passed away last week. We just want to say hats off to Gordon Moore and all the great technology people that have made America what it is today. So thanks, Gordon, for sure. Also, we're just about to end it today. I just want to mention on the Leadership Matrix blog post, which you can find at Leadership Matrix by searching leadershipmatrix.com, or you can also go onto the FourStar website and see the microsite screen a little bit down the main page where the Leadership Matrix is housed. And we have an article about a second chance to make a first impression. One of the things that's happened is in this environment where we've been locked up because of the pandemic for the last couple of years, or many people, some more than others, a lot of people forgot some of the people skills they needed to shake hands and smile at people and make a good first impression. So we found an interesting article about a second chance to make a good first impression. That's on the Leadership Matrix blog post, along with all the other comments that we made recently. And then also, I wanted to highlight a podcast interview. And of course, you can go exactly where you're getting this podcast if you're listening by podcast to Apple iTunes, Stitcher, Spotify, all the other services, Google Podcasts, and you can find our series. We interviewed Dane Sanders, who is an investment banker in Chicago, gives us an update on the capital markets. The economy is slow, so capital formation is slower than it normally would be. But nonetheless, we hear from Dane, and Dane tells us a little bit about what's going on in the capital markets. For the economy to really recover, the capital markets have to be strong. Capital formation, funding companies going public, that's part of the process. So that's what we're hoping to do, and Dane will give us an update on that as well. So, Jack, I think we've done all we can do for today.
Brian, thank you. It's been my pleasure, and let's hope for stronger markets.
Let's pray for America. Let's pray for our president. Let's hope things go well, as I always say. And why don't we leave it there until our next episode of the Today's Market Explained FourStar Media event. Thanks, everybody, for being with us today.
Thanks again.